corruption is so bad. The only thing that was saving Russia was high prices of oil and gold. In 98, barrel of oil went down to $10. Okay. And there were so much promises made to pensioners and stuff. Those have to be maintained. And they had a president who was literally a drunk. I mean, he came to press meetings drunk. You watch him and he's drunk. Not just a red nose, but the way he slurs his words, the way he can basically cannot stand. He was the president before Putin, Boris Yeltsin. He was a big hero in 1991 when there was a coup attempt against Mikhail Gorbachev. But after that, he became the president of Russia, and the country was going to explode. About mid-August, on a Sunday, we were actually out as a desk for a dinner, and we got a call from our economist in Russia. He had a lot of connections in Kremlin, and he says, go back to work early tomorrow. Tomorrow they're going to declare moratorium on foreign currency transactions, which is a fancy word for we're not going to pay anything in foreign currency, which is tantamount to default. Of course, there was nothing we could do in terms of ruble. Next day, we figured Germany was a lot more exposed to Russian debt compared to US. So we shorted Deutschmarks, bought US dollar, made a lot of money, which barely covered 60% of the losses we made from other Russian products. But still, it could have been worse. Next morning, ruble was trading at 30. 6 to 30, which means ruble lost 80% of its value in one day. Now, you're a Russian bank. You promised to sell me US dollars at 6.15. So if I pay you 6.15 in rubles, you promise to sell me $1 on the maturity date. But, where are you going to get that dollar? You have to get it from somewhere. Even if you had your own dollar, that's one thing. Well, you have to pay 30 rubles for that. They said our government doesn't allow us to do it. So that was one way they didn't perform their end. The second one was if I buy that at 30, I'm going to go bankrupt. So I'm basically reneging on that. So our guy basically went down to zero. I mean, we couldn't have it. Those things have a limit of zero payout. So he lost $250 million. The only reason I believe he's still alive, or at that point he was alive, he was the son-in-law for the CEO of the company. Otherwise, he would have been back somewhere. Of course, we lost quite a bit of money on that too, because, whatever he cannot cover, we had to. So when you buy structured product like that, you always have to pay attention. Let me show you another one. We had a product that was based on expected devaluation of Turkish lira. In fact, we call this deval note. Deval is short for devaluation. It was a note that is based on devaluation. We said the following. Pay us $1 million. We will add another 3 million and convert them to Turkish lira. Those days it was TRL, now it's TRY because they got rid of 6 zeros those days. Later on, invest into short-term TRL denominated and we would promise you a fixed yield on your dollar investment if USD TRY was below a certain value calculated using expected depreciation. And you started losing yield as the exchange rate at maturity was above the threshold, and at even a higher threshold you were knocked out. And we returned some value to the customer. We basically said something like this. Suppose spot exchange rate was, let me think of those days, 500,000. Let's do it in thousands. Product is for 3 months, and expected devaluation. Those days, Turkish Central Bank kind of micromanaged the exchange rate market. They didn't let the exchange rate depreciate more than the expected inflation. So they tried to keep the real rate stable. Say 4% a month, which was rather common. 4% a month is equivalent to 60% annual inflation. And that was a kind of average number in the 90s for Turkey. That means expected exchange rate in 3 months was, let's see, 500 times 1 plus 4%, 562 and something. Turkish treasuries yielded about 80% those days. So how would we even think about pricing this? Now I'm going to basically write down the components of the product. We'll think about pricing next time. Essentially, the return structure is as follows. I have it. Okay. Come on. It decided to be slow. This is kind of, let's call this X1. This is base. Something like that. I don't know why I couldn't write it. It looks a lot like the option kind of payoffs, right? Which means if the yield is going to be flat below that X1, essentially the client is selling me a call option on the value of USD Turkish lira, right? Expected inflation, expected depreciation. That means if the exchange rate remains below X1, I'm going to act as if I'm going to convert the proceeds of this investment back to US dollars at X1. So think of it like this.